Yeah, what I love about the One Big Beautiful Bill is unlike a lot of other bills historically where really, emphasis big corporations or specific industries, the One Big Beautiful Bill really encompasses benefits for all types of people, right? You got a gig worker earning tip income. You have just regular W-2 workers working overtime, overtime bill. The new bill also includes tax-free overtime income up to $12,000 for individuals, $25,000 for married couples. So same concept, working hard, don't have to pay that much in tax.
All right, guys, welcome to another episode of The Report. And I got a repeat guest. I got someone coming on for not the second time, but for the third time. She is a tax strategist, and we are going to talk so much game. I got Amanda Hahn. Amanda, welcome back to the show.
Yeah, I am so excited to be here. We actually have so much great new information.
Yes, I am very excited. So much to dig into, so much to cover here. The One Big Beautiful Bill just dropped July 4th, and we're going to talk about how the biggest tax cuts, some of the biggest tax cuts in history are going to affect your wallet. And let's just jump into it. Amanda, first things first, tax benefits more than doubled. 100% bonus depreciation just came back, effective for anything that was put in place after January 20th. Elaborate on this new tax bill.
Yeah, well, in the old law in 2025, we also had bonus depreciation, but we were only able to write off up to 40%. And so now with it going back to 100%, if you are a real estate investor or even just a business owner, whatever the old expected tax savings just more than double, right? Because we went from 40% all the way up to 100%. I think one of the frequently asked questions I get from my investor clients is, why January 20th? What if I bought properties before that date? Does it apply to even last year? And unfortunately, the answer is no. It's only for properties or assets that you put into service and purchase after January 19th. But the other really cool thing is, unlike the old law where, I don't know if you remember, but bonus depreciation would dwindle little by little every year, went from 100 to 80 to 60. This is supposed to remain at 100% indefinitely into the future.
100%.
Yeah,
wow.
Permanent. So it's really huge.
Because a couple years ago, it was 80%. It's like, okay, like you could feel a little bit, but not really. 60%. You could feel that. And then this year was supposed to be 40%. That's a significant drop off. So for it to go from 40% back up to 100%, that is a huge win. We acquired our most recent hotel in March of this year. So I'm excited for it. We're going to get a cost seg study and really supercharge our depreciation. So I'm very, very excited for that. Anything else to note with the 100% bonus depreciation come back? When you say it's forever, like, are you saying like, hey, this is forever, or just for the next 4 years?
No, that's a good question. So it's intended to be forever, but of course, tax laws could change, right, based on what Congress does. Although changes are usually much more difficult to come by. So we're really excited about the fact that it's intended to be forever until a new administration decides to change. And obviously, they have to get the vote from Congress to remove that tax benefit. That's super exciting for your hotel because that's a great example of how tax benefits just doubled, right? If you bought that property in January, you get 40%, or January 19th, you get 40%. But now, because you bought it in March, you'll be able to get 100% bonus.
Yes, 100%. And this applies to not just real estate, right? What else does this apply to?
Bonus depreciation, all assets that are used in a business, for example, equipment, furnishing and fixtures, vehicles. So anything that's eligible for bonus depreciation, this would apply to it. And I don't know why exactly January 20th was the date, besides the fact that that's obviously inauguration date for President Trump. So maybe there's a little bit of narcissism that, hey, you didn't vote for me last time around, so all you suckers that bought, assets in the middle, you don't get that bonus until I became president again.
Yes, absolutely. That's too funny. All right, next up, Code Section 179 has some changes. And Code Section 179, to my understanding, is to where you can write off vehicles, machinery, anything that weighs more than 6,000 pounds. Elaborate on what is Code Section 179, and then tell me what some of the changes are.
Yeah, Code Section 179 is sort of like a sister law to bonus depreciation. When you mentioned the 6,000 pounds, typically that applies to vehicles. So if we buy a large truck or SUV over 6,000 pounds, we use it for business. What we typically do is we use bonus and or Section 179 to maximize the tax write-off.
Airplanes or boats?
Yeah, so outside of vehicles, boats, airplanes, any kind of equipment that's used in your active business. Generally, that's available for Section 179. So with the current change, it increased up to about 2.5 million is the annual amount that you can expense immediately. Basically similar to the bonus depreciation, right? It's just saying, hey, we're taking something that we normally have to write off and depreciate over multiple years, but I'm going to give you the ability to expense it immediately right away. So this is a really big one for a lot of my clients that are in the construction business. You can imagine heavy equipment, heavy machinery. So super, super helpful. I will say the one major difference between 179 and bonus is that in bonus depreciation, we can bring the income of that business down to a negative, which is what we see with rental real estate, right? We have cash flow income, but we show a big negative on the tax return. With Section 179, it only brings it down to a zero taxable. And so that's why a lot of times in a specific business, what we look at is using bonus and Section 179 to sort of get that intended optimal tax savings.
Can you give us an example of how a high income earning business owner can write off a $250,000 G-Wagon?
I don't know the weight of the G-Wagon. I'm assuming it's over 6,000 pounds. But yeah, I mean, as a business owner, one of the main things you want to be able to make sure you substantiate is the business use of that vehicle. So if you're a business owner, that car is used primarily for business. Let's say it's 100% used for business. You have another car that you use personally on the side, then that business could potentially be part of 179 or bonus depreciation or combination of the two to write off the entire purchase price. So the key with all that is obviously just documentation, right? How do you prove that this car is used 100% for business?
And how long do you have to own that car or have that boat for or own the airplane for before without having to worry about the recapture?
There's generally always going to be recapture when you sell the asset. So the longer you hold it for, the better it is. One of the things that you want to try to do is you want to try to use the vehicle for business purposes, at least for a couple years. I know there are people or CPAs who will say, oh yeah, use it for 1 year, take it out of service the next year. The potential pitfall to watch out for in that scenario is like what you mentioned, right? If I just take it out of service, now I have to pay recapture taxes because it's no longer a business asset. And if you think about the intent of the law, right? The government wants you to buy assets used in your business to help you generate income. That's the reason you're getting the write-off.
Yeah. And I think a lot of people always like ask, and this usually comes from hate always comes from below, but I think people always say, like, oh, it must be nice, all these tax breaks for business owners and real estate investors. It's like, well, no. Everyone plays by the same tax law, and the government wants to incentivize certain things, right? So if you go invest in real estate, you improve communities, you provide housing, you're going to get a tax break. If you go invest into energy, clean energy, you're going to get a tax break. You go invest into farming and you produce agriculture, you're going to get a tax break. So the government incentivizes certain behavior because it helps society, it helps the economy, and it helps the world move forward. And if you do those things, you get a tax break. And so for the people out there that are always like poo-pooing, oh, it must be nice. And like, if you're a real estate investor or business owner, must be nice. Like you guys are just like skipping out on IRS and taxes. It's like, no. You guys all play by the same tax laws. Learn the tax laws, or even better, just hire and work with really, really good tax strategists to where you just lean on their expertise and they're going to give you the proper guidance on how to operate so you can maximize your tax benefits and pay less taxes.
Yeah. I mean, I love how you said that too. The whole tax system is sort of a carrot and stick, right? It's trying to incentivize you to do the right things. And a lot of people will say tax code favors wealthy, favors real estate investors. I say that sometimes too, but the reality is we all play by the same set of rules. And, just because someone's wealthy doesn't necessarily mean they could save on taxes. They only save on taxes when they do those things that the government is incentivizing us to do. So if I go out and buy a nice big home for myself, I don't really get a lot of tax breaks. But if I go out and buy rental real estate to provide housing, then that's how I get the tax break. So it's really about doing the right things during the year and, being able to provide services, provide jobs, provide housing. All those things are what gives us the tax benefits and obviously to help us build wealth as well in the meantime.
The tax benefits favors the educated and they tax the uneducated. It's as simple as that.
Yeah. And I think for a lot of Americans, unfortunately, the narrative, at least out in the media, is that the tax law is only favorable to big corporations. that there's nothing we can do as individuals to change our facts. But the reality is a lot of things we cover today are going to talk about exactly what you can do to change your facts.
Yes, absolutely. All right, next up, qualified business income deductions is 20% now this year. Elaborate on that. What does that mean?
Yeah, so this came out actually under the last Tax Cuts and Jobs Act when Trump was initially elected as president. That was set to expire as of the end of this year. So the One Big Beautiful Bill brought it back. So that, we'll continue to have that going forward in next year as well. It's a big name, qualified business income tax deduction. At the heart of it, what that means is up to 20% of certain business income could be tax-free. It applies to all types of income. If you have, you're a doctor having medical income, you're a consultant, you're a CPA, social media influencer, up to 20% of your income could be tax-free. So if you make $100,000, maybe $20,000 would not be taxed, and you only pay taxes on the $80,000 in an example.
Social media influencer, the first 20K could be tax-free as well, huh?
Yeah, it's all types of income, and also applies to real estate. Yeah.
I love that. All right. This one's big because everywhere you go now, there's taxes on, not taxes, you pay tips. Traditionally, just like you go to the service industry, restaurants, you go out to eat, you go to the bar, yes, it's common to tip. Not in some countries, but in America it is, right? And now everywhere you go, I feel like you go grab a smoothie or you go to Starbucks, you're going to be expected to tip. And I always like to take care of folks. It's the right thing to do. Now, for all those folks in America that earn their money on tips, there's now no tax on tips up to a certain amount, I believe $25,000. Break down the no tax on tips.
Yeah, it's really interesting because like you said, now tips are so prevalent, right? Uber drivers. And so if you're someone who part of your income is from tips, then up to $25,000 of that could be tax-free. The way it works is you still have to report the income, but we get a deduction against it. So if $25,000 of tip income, we write off $25,000 of losses or expenses against it. Now you're not paying any taxes. So super significant. If you're someone making $75,000 for, on your regular income as well as tip income, normally you would have had to pay tax on the whole thing. But now with this new tax benefit, you're only paying taxes on the remaining 50 that you have. And what's really important about this new tax change is it's not just for W-2 employees. Obviously, if you're a W-2 working in a restaurant, you get tips, but it also applies to 1099 people as well. So if you're like an Uber driver or something, super, super significant tax saving.
That's
and brand
huge.
New.
That's huge. I mean, that's putting $25,000, and depending on your tax bracket, that's potentially putting $5,000 to $10,000 back in your pocket. That's huge, and that $5,000 to $10,000 big picture is going to go into the economy and stimulate the economy. I think it's a big win for everyone in America.
Yeah, what I love about the One Big Beautiful Bill is unlike a lot of other bills historically, where really emphasis big corporations or specific industries. The One Big Beautiful Bill really encompasses benefits for all types of people, right? You got a gig worker earning tip income. You have just regular W-2 workers working overtime. Overtime bill. The new bill also includes tax-free overtime income, up to $12,000 for individuals, $25,000 for married couples. So same concept, working hard, don't have to pay that much in tax.
Totally. Okay, so let's talk about that. So $25,000 of overtime income is not taxed at all. Like, it's not just that your tax bracket's not going to tick up. It's just not, it's tax-free basically.
Yeah, potentially tax-free. There, of course, with anything in taxes, there's all, different phase-outs and income limitations. But yes, up to $25,000 as a married couple of overtime work could be tax-free. Now, the really important thing, $12,000.
Okay, got it. So if you're married.
Yeah.
The same thing with the tips is if you're married, it's $25K?
I think it's just $25K for tips. Yeah, I'm not seeing any difference.
If you're single or married.
Yeah.
But that overtime is if you're married, it's $25K.
Yes.
$12,500 if you're single.
Yes. Now, I'm not seeing the haircut for single people for tips. Now, what's really important, though, is the tax law came out, right? In the next couple of months is where the fine print's going to come out. So Congress, IRS is going to put all the fine prints into what is it? What are the definition of tips? What's the definition of overtime, right? So all the nitty gritties. And so there's going to be a lot more to share and keep an eye out on in the coming months as they release more information on all the different definitions. But with respect to overtime, one thing that's really important to understand is what they've said already is it does have to be separately reported on the W-2. So if you're working a W-2 job, the employers hopefully are all taking care of that, where they know, okay, if you're paying overtime, it's showing up differently than your regular compensation. So that's how you know how much of that is going to be tax-free.
Hey guys, this podcast has officially become a top 1% business and real estate podcast. And as a special thank you to you guys, the listeners, I'm going to be doing a giveaway between now and July 31st, giving away $1,000 cash prizes, custom built swag compliments of built, and yacht tickets to come out to our yacht meetups this summer out here in San Diego. To enter to win, simply drop a 5-star review on Apple Podcasts or Spotify, screenshot the review and email it to giveaway@summerscapital.com, and we'll be selecting lucky winners July 31st. Again, thank you so much for the support. I would not be doing this if it wasn't for you guys. So thank you from the bottom of my heart. Now let's jump back into the show. This is huge for I used to do air traffic control, and there's a huge shortage of air traffic controllers. That's been the case for decades now. And they have mandatory overtime at a lot of facilities. And I know when I was doing it, it's mandatory overtime. We're working 56 hours a week often. And that's a lot of overtime hours throughout the course of a month. And so for the first $25K to be not taxed, that is a huge win for air traffic controllers, anyone working federal government jobs to where they have mandatory overtime. I think police officers too, a lot of mandatory overtime right now. So for you guys to get $25,000 of overtime income tax-free, that's a lot of money right back in your pockets. And if you're making a couple $100,000 a year as a police officer, the $25K could equate to, you're looking at potentially 40% of that, right? That's a lot of money.
It's really
that's
interesting.
That's $10,000 back in your pocket.
First responders, right? CPAs. In our firm, we do require mandatory overtime in tax season. So and something really interesting, right? We just talked about a lot of these income. We just talked a lot about these tax-free income that are brand new, never had it before. And so for a lot of people who are working at a job, they get their taxes withheld normally through the course of every paycheck. One thing to talk to your CPA about today is, should I change my withholdings? Can I change and reduce how much is being taken out of my paycheck every month so that I can get the cash back immediately rather than overpaying in taxes and then waiting until next April to then claim a refund?
That's so good. That's so good. All right, next up, Amanda, we got SALT, state and local tax. What is going on with this? What does SALT mean? Break it down for us.
Yeah, so SALT, state and local taxes, under the old rule, as individual taxpayers, we were only able to write off up to $10,000 maximum against our income as an itemized deduction for personal state income taxes we pay, as well as primary home property taxes. So as an example, if you live in California and you pay $30,000 in your primary home property tax, and then you pay another $30,000 of state income tax, that's $60,000. But we were only able to write off $10,000. So the rest of it is just non-deductible. We lose the benefit. Under the One Big Beautiful Bill, that $10,000 cap is now increased to $40,000. So in that same scenario, somebody who spent $60,000 on home taxes as well as state income tax, we can now write off up to $40,000 of that. So very, very beneficial for anyone who owns a home that pays a lot of property taxes and anyone living in high taxing states like California, New York, Hawaii, just to name a few.
This is big because I've always felt like owning a primary residence, there's not a ton of advantages, right? Versus owning rentals. But this going from $10,000 to $40,000, it makes it a little bit more advantageous owning a primary residence. I mean, think about it in this perspective, tax benefits essentially quadrupled for owning a primary residence, if you want to look at it that way. So huge win for homeowners across the country, and there's a lot of homeowners in the U.S. I think, what's homeownership rate in the U.S.? I think last time I looked, it was 67%-ish. That's huge. That's a lot higher than I would have thought.
For sure. And it's interesting, too. I think if you look at the stats, the younger generation are less likely to own homes, right? Less incentive, hard to get into it. And hopefully now with the new perks, it's incentivizing more people to get into home ownership.
But I get it. I mean, the whole American dream, buy a house, get married, and live happily ever after. Now with less people getting married, less people having kids, more people valuing experiences and traveling, working remote, I get it. I totally get it. Outside just the tax advantages. Okay, big win there with the SALT. Next up, child tax credit changes. Talk about this.
I mean, we've always historically had child tax credits, but now it has been enhanced. So I think it's now up to $2,200 for child tax credit. There's actually a new credit for newborns, I think up to $1,000 for having babies. And one of the newest things I think that's pretty hot topic is the Trump.
That's the new credit for giving birth.
Yeah.
It's $1,000 plus the $2,200.
Those are, so the child tax credit, and then there's a new credit just, for
Got it.
having kids.
So this would be like for someone that's like a surrogate, just going to like give birth and then actually not have the child. They're going to, it's a child for someone else. They would, if you're a surrogate, you're now going to get $1,000 tax credit for giving birth.
I don't know. I don't think so. I think it's for, the parent who's going to have the actual child. The intention
the surrogate
of that,
should get something. That's a lot of work right there.
The intention for that $1,000 is loosely connected to the Trump accounts. That's another brand new tax perk for kids under 18 years old. Now you can fund up to $5,000 into the Trump account. So it's kind of similar to, what we had in terms of like IRAs and Roth IRAs. So brand new thing for, people at younger age start saving, and that money could be invested in, stocks, bonds, and things like that. Currently, I don't know that it's eligible for self-directed, but we'll see. Maybe they'll allow for that too.
And give us an example for the folks listening to this that have children. Give us an example of how this would work.
Yeah, so if you have like a 13-year-old or a 10-year-old, then you can fund up to $5,000 into one of these Trump accounts. Once the money is in the account, then it could be invested, stocks, bonds, mutual funds, and to be determined whether we can also use it for things like a self-directed into real estate.
That's huge right there. That's huge. And that's per year.
Per year.
So that compounds. I mean, over the course of 18 years,
child.
That's a lot of money right there.
Yeah. So have more kids.
You could potentially, that compounded over 18 years, by the time your kid graduates high school and becomes an adult, that could potentially be $500,000 right there.
Yeah. And my
Huge.
understanding is that they want the money to remain in the account until the kids are at least 18, but the intention is for the money to keep remaining in that account and continue to grow within the account.
Until age 59 and a half. I love it. All right. So next up, potentially, you can make more money by retiring your spouse based on the tax laws and all that sort of stuff. What does that mean?
What's interesting is I often have clients who come to me as a couple where you have one person making really high income and another person who has a good job, but, maybe a little bit lower income.
Now, when you say high income, give what number threshold do you consider high income?
Over $300,000,
okay,
right?
So,
that's a pretty healthy income.
Yeah. So if you're making over $300K, this is going to apply to you. You could potentially make a lot more net income by retiring your spouse if you make more than $300,000 a year.
Yeah.
Break it down.
So if you make over $300,000 a year, you have a spouse who's working part-time or maybe full-time making, let's say, $60,000 a year, right? When you pay taxes, you're paying at your combined level, and so you're in a higher tax bracket. Now, if your spouse were to stop working and instead spend time in real estate, for example, and become a real estate professional, now what you can do is you can use all of the real estate tax benefits like write-offs, like depreciation, and use it to not just offset income from the real estate, but also W-2 income for that remaining spouse who's working. So if you work out the numbers, again, depending on where you live and, what are the real estate tax benefits you're actually optimizing, we often see times where the spouse is giving up that $60,000 of W-2 income in exchange for $100,000 in tax savings. So it's a way to effectively net more profit in your pocket by not working or retiring your spouse.
In this example, if the spouse wanted to retire from her W-2, and become a full-time real estate professional, but put in minimal hours in terms of working hours, what's an example of a good path for that?
Yeah, the reason to stop working is so that you can put in the minimum number of hours required for a real estate professional, because one of the requirements for real estate professional status is more time in real estate than your job. So if I don't have a job, then I just have to have the basic, which is at least 750 hours in real estate. And
per year.
Yeah.
Okay, so you break that down over 52 weeks. It's not much.
Yeah.
What is that?
And it doesn't have to be equally divided. You could have worked for the first 3 months or 4 months of the year, and the rest of the year you're just doing real estate full time. Definitely possible to do. And I think there's a misconception that people think I have to self-manage all of my rentals. They all have to be local, but that's not the case at all. We have clients who have, 1 or 2 local properties that they're very hands-on with, and then a bunch of the rest of their stuff is out-of-state rentals with property managers.
Let me ask you this. Would this example work? Your spouse retires from her W-2, gets her real estate license, and literally just works part-time as an agent only on referral basis. Whenever we have friends or family members that want to buy or sell a house, then you work on the referral basis. And let's just say you sell 3 or 4 houses a year, as a real estate agent, but that's your only line of work, would that qualify both of you as full-time real estate professional?
It's much easier to do that. However, keep in mind, for real estate professional purposes, you do also have to spend time on your rental properties. So yes, so the ideal profile is somebody who's, doing real estate, whether it's an agent, a property manager, and then also managing or handling the day-to-day operations of their rentals. It is a common misconception that people think they have to be licensed and show houses and sell for friends and family to be a real estate professional. But the reality is you don't have to, right? I could not be licensed in real estate. I could just manage my own 2 rentals here locally and potentially be a real estate professional. So don't have to get licensed if you don't want to.
Yes, that's good. That's good. All right. I want to transition, Amanda, here. You got a couple videos on Instagram that got a lot of engagement, a lot of views. One of these videos got 3 million views on your Instagram. And you said if you make $200,000 or more per year, you said if you make $200,000 per year, you lose roughly $70,000 in taxes. Instead of paying that tax, you can buy Airbnbs or boutique hotels and legally pay 0 taxes. What do you mean by that?
Yes. I mean, if you make $200,000 a year, you could be losing up to $70,000 in taxes. So instead of losing that $70,000 in taxes to the government, you can redirect that money by investing in real estate to offset the income. Now, if you're working full-time, then what we typically like to work with is the short-term rental tax loophole. Why do we call it a loophole? Why do we call it a loophole? Because it's one of the few ways you can invest in real estate where you could keep your job and real estate could be a side hustle, and you can use all the real estate tax benefits to offset the income from that W-2 income. So we have a client who bought 1 short-term rental property with acquisition and taking depreciation on it, writing off the furnitures and fixtures and all of the supplies, then effectively creating $200,000 of tax benefits to offset all the taxes on that W-2 income.
That's huge. Do we ever run the risk of this going away?
We do, right? Because I know sometimes people say it's not a loophole, it's what the tax law is. But I personally really think short-term rental and even boutique hotels, these are loopholes because the government did not intend for these to have these different requirements where you don't have to be a real estate professional, right? So absolutely, as Airbnb gets more and more exposure, more and more people are doing it, I would not be super shocked if some of these benefits go away. So I always tell people we can't take these tax benefits for granted and say, maybe I'll invest in a hotel 3 years or 5 years or short-term rental down the road. Take advantage of them while it's available.
Yeah. People always talk about utilizing this short-term rental loophole, but I'm like, man, what about going and buying a small boutique hotel? Some of these small boutique hotels you can pick up for $1 million. It's not anything much more than median home price, I think in San Diego is around that. And so you can go pick up, some of these boutique hotels for about the same cost of a single family home and not only get the depreciation and the tax write-off from the cash flow it spits off, but also use it to offset your W-2 income, your career income, everything that you just mentioned. That's a huge tax break. All right, next up, you had a video that got 1.4 million views and you said, parents, don't miss these tax breaks. Child tax, child care credit, medical expenses, and travel for medical care, etc. Elaborate on this.
Yeah, and even summer camp too, right? A lot of parents don't know that they can write off these different child-related expenses. And also, we just talked about earlier with the One Big Beautiful Bill, there are expanded child tax credits, new credits coming out, the new Trump account. When we talk about what do we spend, let me say that again. When we talk about tax planning, one of the things I always look at is what are all the things I'm spending money on already? And how can I turn them into legitimate deductions, right? Your kids, obviously, the older they are, the more expensive they get. And so, at the younger ages, we're looking a lot at these different types of credits, sending them to camp and things like that. As your kids get older, if you're a real estate investor or a business owner, now we can save even more in taxes because now we're looking at shifting income to them. How can I pay my kids to have them work in my business, in my real estate, and get a tax write-off for my business while having that money be potentially tax-free to them?
Example of paying it.
Yeah, so have a rental property and, let's say it's an Airbnb. I need someone to help me with tenant turnovers, cleaning, restocking, buying supplies and all that. If I can pay my kids the same amount of money that I would pay somebody else to do the same exact amount of work. So if I'm paying a couple $100 every time there's a guest turnover, then now all that money is a tax deduction for me, and again, potentially tax-free to the kid. If we're talking about paying somebody $15,000, right, to a child for the year, if I'm at a 50% tax bracket between federal and state taxes, that's $7,500 of actual taxes saved on money I was going to give to my kids anyway, but now I'm forcing them to work.
Because how many parents give their kids like chores and give them like some money for it every single week, an allowance, right? So now you just got to document that, correct?
Yeah, and now, and I was watching somebody's reel recently that said never give your kids money for chores because that's what they're supposed to be doing, right? Like you don't pay them for the stuff they're supposed to be doing, but you pay them when they are actually working. They're going beyond like their chores and actually doing stuff for your business, for your real estate, because now that's a business deduction versus for chores, it's personal stuff. You got to do it anyway, right?
Yeah. Never give your kids money for chores and then do this instead. That's huge. I love that. Okay. Amanda, this has been so great. So much value in this episode. And I'm excited with all these changes. I think it's big for real estate investors. Now we just need to get the interest rate environment normalized and get ready because things are going to heat up. I think things are going to start spooling up, and I'm excited. A lot of good news in the marketplace. Any last thoughts to cover here?
What we didn't talk about was the timing of a lot of these benefits, and two really important things. A lot of these benefits, most of them are retroactive, which means they're effective back to January 2025. So it's not one of those things where like, oh, this is coming, it's going to happen next year, 2026. And so the earlier you start doing tax planning, the better it is, because that just means you have more options, right? We talked about tax benefits more than doubled for a lot of real estate investors. And like you said, tripled maybe for homeowners. And so you don't want to be stuck at the end of the year or April next year wishing I would have done these things to take advantage of all these tax savings. Like I said, start planning now. If you're a worker, if you're a business owner, a real estate investor, start adjusting how much you're paying into the system every month, every quarter to keep more of that money now so you can reinvest and have that growth.
Yeah, and if you're a high income earner, business owner, real estate investor, you're paying a lot of taxes, like get around a good tax strategist because I'll be honest with you, like 90% of tax people out there, just these normal CPAs and stuff like that, they don't really know a lot of the stuff that we just covered. They don't really know the game. They don't really understand a lot of this stuff. And it's true, but the 10% out there are really good. You're one of them. Carlton Dennis is another one. There's a lot of really good tax strategists out there. And I say, get in front of a really good tax strategist. Bring them on your team because you guys are going to save a lot of money. Amanda, this has been great. Where can the folks get in touch with you if they want to learn more or potentially work with you and your firm with tax strategy?
Yeah, my company is called Keystone CPA, and our website is the best place to find us if you want to work with us. Most people come to us for proactive tax planning because, like you said, a lot of most CPAs don't actually do planning. And planning is how you're going to save on taxes. My passion is in helping to educate people on the fact that you can save in taxes. It's not just something that happens to you, and it doesn't have to be hard. It's something that you can easily do as long as you understand how to play the game. So I'm typically found every day on Instagram,
yeah, you're
Facebook,
all over. Love
YouTube,
the content too.
As Amanda Hahn CPA.
I love it. There it is. She's Amanda Hahn. I'm Rich Numbers. Listeners, thanks for tuning in. We'll see you guys in the next one. Peace.